give it a couple more minutes. We've got about 10 attendees. Good afternoon, everybody. We're just going to give it a few more minutes here before we start the Trade Finance webinar. Waiting for a few more attendees to join. We'll give one more minute here and we'll get started. Appreciate everyone's patience. All right. Well, good afternoon, everybody. I am Michael Salerno, and I am the current treasurer of the National District Export Council. And I thank you, everyone, for joining for the Trade Finance, a primer for maximizing export risk as part of our webinar series. We have with us today, joined by our Education Committee, Shariah and Tom. So thank you for putting this together. And we will go ahead and get started with the webinar here. And if we'll move to the next slide. So again, this webinar is Trade Finance, a primer for minimizing, export risk. We are being we are being joined by Matt Burke, who is a senior advisor at First National Bank. And he will be facilitating the webinar this afternoon. Just a couple of items for housekeeping is that everyone will be muted and will not have camera during the webinar. If you do have questions, please use the Q&A box for your questions, not the chat box. And again, questions will be answered live if they're important to the content. Some of the other ones we will hold to the end as we have reserved some time for questions. Move to the next slide.
All right, Mike. Well, I can get going here. We'll we'll go ahead and switch over to PowerPoint here.
There we go. Perfect. Thank you, Matt.
All right. Awesome. Well, thank you everyone for joining us today. A couple of housekeeping items, as Mike kind of suggested. Please make this as interactive as possible. Sometimes the trade finance programming can get a little bit dry. So the more questions, the more interaction we have together, makes the time go by just a little bit faster. So as our legal department will be happy. I showed every slide, but we're providing this information as a courtesy for general purpose, reference purposes only. We're not offering investment, financial, tax, legal, or business advice. So this is something that when you enter some of these, they do have some tax, financial, business implications. So just please make sure that you're really bringing everyone in to make these decisions. So our agenda for today is we're really to discuss a couple of ways of doing business and utilizing trade finance to really grow exports. And the first two we're going to talk about really don't involve much outside of just utilizing different payment terms and finding providers for those services. And that's the letters of credit and trade credit insurance. To me, I think these are really kind of the easiest two to hit a home run with when trying to increase export sales and maximizing working capital for your business. And then the other two, we're going to talk a little bit about the export financing programs of the SBA and Ex-Im Bank, as well as some of the medium and long-term financing options that they also provide. So when we do these types of things, I think it's easy to kind of take baby steps at first, and then we can kind of get into the really more dense material of the export financing programs of the two government agencies that we have. I like to think that export sales is really a balancing act. And when we give presentations like this, we'll have someone who's on the finance side of the business, as well as someone who's also on their director of international sales. And to make both folks happy is extremely difficult. To have a business development officer go out and try to find international clients and win business is, they have a goal. They're going to try to do open account on everything they can. Whereas the folks in the finance department are definitely going to want that cash in advance. So, we're really going to be balancing the revenue growth versus the credit risks, revenue growth versus the available working capital to grow the business. And then obviously we have the sales team versus the finance team and different payment terms there. So just something to think about as we work on this. A letter of credit, and my guess is most of you really understand what a letter of credit is, but just to refresh everyone's memory, is a letter of credit is an undertaking issued by a bank for the account of a buyer or the applicant to pay a beneficiary, provided that the terms and the conditions of the LC are complied with. And so, letters of credit are really just an extension of your payment terms program. And we see this, especially here in the Midwest, as, Mike and I are pretty big, and the folks, I know there's some other folks on the call today who understand that letters of credit in some industries are just the standard way of doing business, and there's just no way of doing that. We see that with beef export sales to South Korea. That's just the way they do business. It's all done in letters of credit. We're not going to get away from it. But the most important thing here, in my opinion, is that a letter of credit kind of is this win-win situation. They provide both benefits to the exporter and to the importer. And when selling on a letter of credit, it's still important to understand that while they are an acceptable form of payment, you still should be doing some underwriting on your business's credit side if you're going to be issuing terms or selling to these folks. So you still want to ask for the buyer's financial statements and understand that, most of them are going to be in, IFRS. They're not going to be in compliance with US GAAP. So there are going to be some difference there. Ask for credit references, again, from buyers and sellers in the local in the local country, and maybe there's even a buyer supplier here in the United States. The other one is, if you are selling on a letter of credit, exporting, is make sure that you're getting the financial statements or a like a Moody's rating or an S&P rating of that financial institution in a foreign country. That's really who you're underwriting in this, and we'll get into that more. But again, when we have folks sell on letters of credit, I still tell them that from an internal perspective, you do want to underwrite this like you are selling on open account. So what are the benefits of a letter of credit from the importer side? And this is where a good sales team in selling your product and exporting to a foreign country, this is where they have to really do their selling. Not only are they selling their product, but they're selling your payment term. And so the benefits there are, the shipment has to be on time, the quantity, quality certifications are included, and the correct documents are provided for customs clearance. The last thing an importer wants is to have all of their goods at port, sometimes with an expiry date in a reefer container, and they can't clear customs because there's some document that they forgot to ask for in the letter of credit, or ask for at any time. Well, in a letter of credit, that importer can ask for whatever they want from a document perspective, and they'll usually do that with the assistance of their logistics provider. So again, having the correct documents for customs clearance is always a huge selling point when exporting goods. And then the other thing that again we see a lot is that the payment is not going to be required until the goods are shipped. That bill of lading, whether that's air, ocean, is going to be a required document on 99.9% of all letters of credit. I can think in my 13 years of international banking experience, the times that we have a letter of credit that doesn't have a bill of lading on there. We just have to make sure that things are shipped on time and are good to go. And then you can obviously negotiate the terms on this for payment. So, we can do 60 days bill of lading, 30 days bill of lading, whatever it may be, to get those goods overseas. What are the benefits then to you, the exporter, on a letter of credit? And the one thing that I always tell my customers is, if you're selling on a letter of credit and your buyer says that they can get a letter of credit and issue one to you, congrats. That's awesome. Someone believes that your buyer is creditworthy. And so that's the number one thing, right? We talked already a couple slides ago about underwriting like you would you're selling on open account. You probably already understand that your buyer is creditworthy, but having the confirmation from a foreign bank that they'll also issue a letter of credit on their behalf is a big thing. So what happens here as you're the exporter and this letter of credit is issued, the payment risk shifts from the buyer of the product to the issuer of the letter of credit. And so now you're not going to be looking to that buyer, you're going to be looking to that bank for repayment. And so, you can add this as a receivable to your borrowing base, and we'll talk about this in the next slide. But then, we can also take away that foreign bank risk and add a confirmation from a local or a reputable bank that one of the rules of confirmation is, that you don't use a branch bank, you don't use the affiliated bank. So if you're doing Bank of Tokyo, you're not going to do the Bank of Tokyo branch in New York as your confirmation. Really, if one bank is going to fail, they're probably all going to fall as kind of like a domino effect there, and they'll all kind of have their issues. So getting paid the confirmation fee and from a sister or an affiliate bank just doesn't make any sense. If you're going to pay the funds to have an LC confirmed, make sure it's with a third party bank that doesn't necessarily have any affiliation or ownership, that would be the same. So just a helpful hint there. So utilizing export LCs as a trade finance tool is fairly simple, and what it does is it allows you as the exporter to put a receivable on your borrowing base to lend against. So what's the borrowing base? That's really, the amount of money that a financial institution is going to loan a company based on the value of collateral that's on their financial statements. Now, with asset-based loan agreements, you're going to see a variety of different, structures in those sorts of areas. So you can have an asset-based loan agreement where you have to provide a borrowing base every week or twice a week, or twice a month or monthly, whatever it may be. But that bank is then looking at those assets to make sure that you have sufficient working capital assets, current assets, to allow to allow you to draw on that working capital line. So why is it important? Typically, utilizing export LCs is a bank's not going to allow for any foreign receivables on your borrowing base. That's boilerplate language on 99.9% of most banks, whether they're large or small. Adding a foreign receivable just adds a bunch of complications. So the boilerplate language I know in most banks here in the Midwest is the first thing it says foreign AR is excluded. So if you have an AR listing for your organization, you go through it and you just have to zero out whatever that may be, whether it may be $1 million, whether it's 50,000. So sometimes that can be a big deal. But if you do talk with your lender, export LCs are a really good way to add those to your borrowing base. There is a certainty of repayment on an LC that you don't necessarily get with just an open account. And again, you now have a more reputable, easily searched bank that we can determine what a Moody's or S&P bond rating is for that institution. And whether you have a bank that has a fairly conservative credit culture or a little bit less conservative credit culture, what you're going to see is that LCs, in my experience in looking at borrowing bases for quite a bit, is they're given preferred advance rates, and obviously you can go anywhere from 75% advance rate all the way to 100% advance rate. It just kind of depends again on the product that you're selling, its marketability, and how often that you're providing these type of borrowing bases. And then it does allow sometimes the inventory as an asset. So when you have a letter of credit that's received, you can then have the assets, the inventory that you need to make your product or get it out the door, that can be utilized as an asset on the borrowing base. So we have both the receivable and the asset, the inventory as assets there. Again, this is import LCs as a trade finance tool. So again, this is where, again, your sales team is going to be attempting to do all they can do to sell your product, but then sell the payment terms that make it a win-win for everyone involved. And then you'll see this, the main thing here is the use of a discounted use and LC. Again, this is really a win-win situation. Exporters get paid traditionally at site or upon examination of the documents. If you, the exporter, provide all of the documents that are needed to comply with the letter of credit, you get paid right away, where the importer of the goods may then also be able to take 60, 90, 120. We've seen some as far out as 2 years to really pay. Now, there are costs of doing business like this. And so usually they're going to be very similar to what the local interest costs would be. But the sharing of those costs can also be negotiated. So that's something that you can add in your invoice, your pro forma invoice. You can add that to the letter of credit, however you want to do that. But selling an import LC as a trade finance tool provides some benefit, like I said, for both the exporter and the importer.
Okay, and that,
So,
where you did get a question, I think that was relevant to the slide. It says, will a lender allow a non-confirmed LC as part of the borrowing base?
Yes, and again, that is. Thank you, Shirai. Thanks for sending that over. It really does depend on the credit agreement and again what you're selling. That's my experience. The folks who are selling grains and ingredients, you're going to see that's again a typical way of doing business. Those receivables, those letters of credit will be able to be added to the borrowing base. But if you kind of sell a product that may not be as marketable, readily marketable, you may not be able to add as much of that to the borrowing base. In my opinion, a confirmed letter of credit does basically shift the receivable from a foreign AR to a domestic AR. Again, because you do have the account receivable now from the US-based bank. Hopefully that's what you've done. Again, I wouldn't sell something to Japan, have it confirmed in Italy, and then that again just creates a level of confusion for all on board. So if you're going to confirm it, do it with a US-based bank, do it with your primary financial institution. But I would say yes, most of the time, if you have an LC, it should be able to be included just on a normal borrowing base. The confirmed LC for sure. If you have a confirmed LC, I would almost say that's closer to that 100% advance rate for working capital. If you just have a normal LC, you may see somewhere in the 90 to 95% advance rate based off of the commodity that you're selling. So we went a little too far. There we go. Trade credit insurance. So this is another option, I think. Again, if we're talking baby steps on this trade finance really paradigm, we can talk about utilizing the letter of credit, the payment term, but then we can also do something on the backside called trade credit insurance. And it really is protecting your organization against the failure to pay from your customers. And this is both foreign and domestic. And so one of the things I think that we see here is we have a very large asset. If you take a look at your balance sheet on your organization, accounts receivable, unless you're one of the couple banks here on board the call today, AR is going to be your largest asset class most times. Probably 3 out of 4 companies have AR as their largest asset. They've sold on account and are just waiting payment. And again, you sell your product, you ship it, and you get paid in 30 days. That's not a bad way to do things, but that does increase that current asset in accounts receivable. So we'll talk about the use of trade credit insurance here and how we utilize that as a trade finance tool. First of all, one of the benefits of trade credit is just the loss protection. Again, we talked about the largest asset class, and you put insurance on buildings, you put insurance on people, but most folks don't put insurance on their largest asset. And so again, you want to safeguard your revenue stream. You want to protect against losses. You want to protect against margin. And then, when we talk with banks, a lot of folks, and you talk with a lot of trade credit folks, we have customers who have, 75 or 80% of their sales go to one upstream business. And you could talk about that in consumer goods with like a customer who sells primarily to like a Walmart or a Costco. Well, when you get to a certain level of sales, banks really kind of start looking down upon that. And so you want to be able to have an asset here or a tool in trade credit insurance that reduces the risk to the bank and to your business if a Walmart were to slow pay you, or a Costco, or we talk about the beef industry. If you have a upstream supplier or upstream party who just doesn't want to pay you because they have some financial issues. Then you want to talk about sales expansion. You want to increase growth. You can sell to existing customers by extending more credit through this. You can mitigate the risk of expanding sales into more volatile countries. And we'll talk a little bit about that when we talk a little bit about XM. But we can also, have safe, profitable cooperation between sales and credit functions of your business. We talked about that balancing. Financing, again, we talked about improving the power. We'll talk about that here in a few seconds. And then, improving the financial monitoring and efficiency. The one thing the credit professionals will tell you is that the credit risk functions of these organizations, of the U or Hermes, of the Atradius, of XM, they have AR listings for companies all throughout the world, and you can buy reports to improve your credit team's ability to make decisions on whether you're going to expand sales to them, if you're going to offer credit to them. And again, these are just reports that you can talk with your provider and help your organization kind of move through this area a little bit easier. And then, you can increase leverage on troubled accounts by utilizing, the insurer's expertise and their international resources. The last thing a foreign buyer wants is to know that an XM bank or a U.S. company is going to come after them to collect the balance on a sale. So again, just a couple of the benefits here as we talk about trade credit. There's a couple of different types of policies. We got the single buyer policies, top accounts, and full portfolio. Again, we talked about the export sales. Folks will just really do just their international sales side. And that's one way to put things on the borrowing base. We talked about the sales concentrations with the Walmarts of the world, feedlots, feeders, slaughterhouses, those sorts of things. Top accounts, if you want to increase, for longer terms of sale, if you want to say, let's do 90 days, open account, again, if you have this backing, it really does kind of help everyone sell a little bit more, but then gives you the knowledge that you're going to collect on that account. And that just because you increase the terms from 60 days to 90 days, it's not going to then increase to 120 days, 2 months down the road because they start slow paying you. And then you do kind of see some benefit when you do have a large amount of sales is utilizing a full portfolio. So you kind of have this stable group of domestic sales that you can offset the risk of your export sales. So when you kind of combine both, it does kind of the average cost kind of spreads itself out over a bigger asset. So it kind of helps you out there from a cost perspective. So how does it work? You utilize an application that's submitted by the exporter. So you, as the exporter, submit it to an organization. Again, this could be you or Hermes, an Atradius, Coface, or even XM Bank. The cover is going to be approved by the carrier, and pricing is going to be set. So if you just really want your domestic receivables covered, the pricing is going to be a little bit lower. If you just want your export sales covered, that's going to be another price. But if you're selling to underdeveloped countries, that price may be a little bit higher than if you just sell into Canada and Western Europe. So again, you can add accounts over the life of the policy. But what does a carrier look at? That's the thing that XM or Coface, they're all going to be looking at credit bureaus, trade references, bank statements, financial statements, payment history. They have payment histories on almost every company that's out there because they have so many folks who send them monthly accounts receivables that they're able to aggregate this information and understand your company pays on 30 days past due on a normal month. So just something to think about there that they do look at quite a bit when determining if trade credit insurance is a viable option. Claims, that's another question that we have. the insurer, will pay for outstanding invoices, usually within 30 to 60 days of a bankruptcy and 90 to 108 days with a protracted default. But depending on the coverage that you purchase, companies, you can be paid a little bit sooner for slow pay for those sorts of times where a company just wants, another 60 days, but you need paid because you've purchased all of your inventory, you've made and manufactured the goods, and you shipped it out. But once a claim has been made on that sale, the insurer takes the subrogation of the invoices and continues the collection. And so again, political claims coverage, you can companies doing business directly with foreign governments or contractors obtain political risk insurance. And that really protects against payment defaults, license cancellations. If you had to have a license to do something in India or Canada or Mexico, something to think about there. And then asset protection, lenders, investors, contractors, with equipment inventories or cash in foreign countries, you purchase some political risk insurance to protect against, political violence, currency inconvertibility, those sorts of things. Trade credit insurance through Ex-Im Bank. Again, we talked about it. This is really just focusing in on those international export accounts receivable. And we talked about the insolvency and protracted default. This the one thing I'll say about Ex-Im Bank is they are for small to medium-sized businesses, they're about as good of an organization to work with as you can find. Mainly because they have the ability to do the pay-as-you-go. You can do one export sale, you can do 2 export sales, you can do your whole book of export sales. So Ex-Im Bank kind of provides this benefit that if you don't want to fork over the $50,000, your policy, you can go to Ex-Im Bank and maybe pay $1,500 or $2,000 to insure your accounts receivable. So let's talk about how we utilize this as a finance tool. It's going to require collaboration, and just because your accounts receivable is insured doesn't necessarily mean your banker is going to provide this asset and allow you to include that on your borrowing base. Typically, the bank is going to have to be named the loss payee on those accounts or on that insurance policy. And so when you do that, again, you kind of add this ability to have a little better advance rate. So, typically on an accounts receivable, you're going to see anywhere from 50 to 75%, maybe even 80% advance rate on an accounts receivable. But when you have this insurance policy, you're able to increase that a bit when the bank is named loss payee. So again, we're able to take those foreign accounts receivable. You could be selling on open account. You don't need to use a letter of credit or a documentary collection. You can sell just as you normally would, add this trade credit insurance to the portfolio, pay for it, put the name of the bank as loss payee on the policy, and you're good to go. Usually, this is not a very difficult issue to change on your trade credit insurance policy, but it just kind of depends on who your provider is, how long you've been in business with them. If the insurer is trying to change you into a new policy versus their old policy, they may have a little bit of leverage there for you to do that, or on you to do that. So again, just something to think about as you utilize trade credit insurance as a finance tool. And finally, we'll kind of get into the more dense of the trade finance tools, and that's utilizing export assistance financing programs.
Matt, before we go, let's just to interrupt you before we get too far. We do have 2 questions related back to the LC section. So as we were talking about the exports, their question was, are importers under a relative similar restrictions with their bank regarding restrictions on their funds, whether the LC is at site or if they have terms?
You know, that's a good question. You know, most of the time, that's really kind of a tricky issue to tell you the truth. But you know, if a bank is only willing to issue a letter of credit at site versus you know, on additional terms like a 60, 90 day terms, that does tell you a little bit maybe about the financial strength of the end buyer. And so you can kind of look and see, all right, they're able to provide a 90-day payment window on this. That indicates that the bank understands that their customer is going to be around for a lot longer. And so again, that's the part of the credit underwriting of the foreign bank when they issue that LC. And that does tip the scales in your favor a little bit, and it also shows the hand of the financial condition of the buyer of your products.
So we also had a question that was related to the insurance side. So you were talking about insurance and protection around there. The question was related, says, are you talking about having credit insurance on top of a payment via LC?
Again, that is possible. You can provide both. You can kind of double stack those sorts of instruments. And you may find that instead of paying the confirmation fee, utilizing utilizing a trade credit program may offer a little bit better coverage and be a little bit cheaper. But we don't see that very often, to be 100% honest with you. And mainly it's because, I'll use the Ghostbusters analogy. You kind of cross the streams a little bit there. And so usually when you see that, you're going to probably keep most of your stuff in the LC pool versus the trade credit insurance pool. So again, is it possible? Yes. I don't think we see that quite as much through the business that I see. But it is a possibility. And so, that's again, something that your trade credit insurance policy may say, yeah, we'll cover your export sales, or, whether, and when you say export sales, you're basically saying, we're going to provide you, here's the buyers, here's their financial statements. And, will you, provide coverage for that customer? And that the provider may come back and say, we're going to do that and provide coverage if it's on a letter of credit. And that again kind of tells you, if you're utilizing your trade credit professional as your credit and risk department for your company, that tells you something there as well. So, the nice thing about all these products is that they do provide, the buyer has to show their hand. If they're not willing to show you their financial statements, then that's red flag number one. And then if they do provide their financial statements and you flip that over and provide that to your trade credit professional, and they're not willing to extend any coverage to them, that's red flag number two. And so, that's, trade finance is underwriting these risks, and making sure that you can grow the business safely, effectively, and with a sufficient amount of working capital. And if those red flags start popping up, then that may be time where you kind of wash your hands of the deal, and tell your sales team, unless their financial condition improves, or unless they're going to pay cash in advance, we just have to kind of move on and find a new buyer. But if there's any other questions, go ahead.
We're open if you want to continue, and if we have any questions through these programs, I'll stop you and we can address them in the sections that they occur.
Sounds great. So again, I think this is probably the most dense material that we're going to cover, and we have about 30 minutes to 20 minutes to do it. And so I'll preface this that I'm going to provide an overview of these export finance programs through the SBA and XM, but the underwriting of these is really dependent on your financial institution that you do business with and the SBA and XM. And so what we see here is that you can't really paint with a broad brush on this is what's covered, this is what's not, because each business is different, the fee structures are different, the payment structures are different. And so that's just something we need to kind of gloss over here. But I'll start with prefacing this as well, is most U.S. banks view loans to exporters for exporters to support export sales as risky. The primary source of repayment, we've talked about this. Banks look for a primary, secondary, and tertiary form of repayment. And so if the primary is the account receivable, the secondary is the liquidation of assets, I tell you what, no bank, I use First National Bank as an example. We do not want to be liquidating grain contracts in Vietnam. That's not something we do very well, and it's not something many banks around the world can do. So that's why they view it as risky. So XM, SBA come up with these export financing programs to entice U.S. financial institutions and banks to make loans to exporters. And so this guarantee that they provide the bank makes them comfortable with lending to export customers. And again, just similar to how you utilize your traditional working capital program, your working capital loan at your operating bank, it's maximizing your cash flow so you can buy the assets to manufacture your product, sell it, and then wait to get paid. And again, we talked about the assets that are primarily included on this. It's accounts receivable, inventory, work in progress. But we can really separate this into two buckets. We can have your domestic sales, inventory, work in progress on one side, and your export on the other side. We had a customer who was looking into one of these products. He sold into Europe and was looking to go into Saudi Arabia, and he had all of the electrical components for the EU on one side, super easy to delineate which was a domestic inventory versus an international inventory. So that's one way to do it. But when you have a big load of grain that's sitting on a train, what is foreign inventory versus domestic inventory? And it does get a little bit convoluted on how that's calculated. But we'll talk a little bit about how it supports bid bonds, standby letters of credit. And then the one thing you do have to understand is, there are content minimums, both for the SBA and XM Bank. The SBA was established in the 50s, and it's really there to build, grow small businesses, in the United States. They began offering export assistance programs starting in 1998 as a way to really boost the U.S. economy. There's no better economic development than selling your goods internationally. I will say I'll provide a little bit of context here that, for COVID relief, things have really changed. So for SBA guarantee fees and servicing fees are waived right now for loans that are approved by September 30th. This is on all 7A, express, and export loans. The real estate 504 is not included, but there's just a nominal document fee for that. Again, they have to be approved by both your bank and your SBA office by September 30th. You can close after that. But what we're seeing right now is there is a bit of a push to utilize these SBA programs right now because of the reduced fees to the organization. The one thing to understand here is that the SBA, you are limited based off of your size. So if you're a large manufacturer, a large organization, and have, again, generally, it's if you have, you can't not have more than $15 million of tangible net worth, $5 million in net income. But all that is really based off of whatever the NAICS code of your business is. And that, for those that don't understand, that's a North American Industry Classification System. You can talk with your bank about what your NAICS code is if you don't already, but utilizing the SBA size standards, I've included a link, and we'll make sure that that's included as part of the handouts for everyone. They really kind of provide two main export financing programs. One's the Export Express. This is the smaller of the two, and it's really there for a maximum of $500,000. It's meant to be, you have an order, you need to get it out, you need to do it fast and don't have time to really do the full export working capital program. This can be approved through the SBA, your SBA preferred lender, and it doesn't necessarily need to have the SBA full approval to get that done. Now, when we move into their larger program, which is the SBA Working Capital Program with a maximum of $5 million, that's going to require both the preferred lender and the SBA to approve that. And there's three real variations on that working capital program. There's the single transaction, the asset-based, and then the transaction-based. So the single transaction is usually a non-revolving loan that supports specifically identified export transaction. So usually less than 1 year, can go up to 36 months on that. Again, this could just be to purchase inventory or support some AR. Transaction-based revolving line of credit supports, one or two or multiple export transactions, and throughout the continuous term of the loan, usually again about 1 year or less. And then the asset-based loans is just, again, really closer to what your working capital line of credit is today, and involves the borrowing-based certificate assets, and understanding how much you can advance to grow your international sales. ABL loans typically set on 12-month amortizations and reissued on an annual basis. But again, I'll be very respectful of everyone. Each one of these programs is very specific on the types of transactions that they can do, and so you do have to talk with your lender on if you're going to qualify for that type of product and that type of solution. Then we move over into the XM Bank, and then that's, its mission is to create and sustain jobs by increasing exports. It is an independent agency of the U.S. government, and fun fact, it's really the only one that really makes money. So $7 billion has been returned to the U.S. Treasury. That's since I believe like 2016. And it was kind of this political football, but the folks that are on this call understand the importance of XM Bank, and we don't really need to involve politics in this. It does help small, medium, and large-sized businesses export goods across the globe. And if we've seen anything in the last few years, it's that the utilization of other countries' export-import banks are increasing, and we need to make sure that that we utilize XM to its fullest potential, similar to the SBA's charter. It was last reauthorized in 2019, and its charter was renewed until 2026. So that's good news there. The programs that XM offers is kind of nice. They utilize this FILO, the first in, last out. XM is going to be the first organization to go in to a country once it opens up from whatever sanctions, war, whatever may be happening. They're going to be the last out before all the private companies will have been out for quite a while, but XM will stay in and help you do business in those countries. When will they get paid? You can use their insurance products. How I get cash to make the product, that's their working capital. And then they also have their structured and project financing. The working capital guarantee program, that's probably their the most popular one from a trade finance perspective. We talked a little bit about the about the trade credit insurance, but from just the simple loan side, this is the most popular of the two. Generally, it's a 1-year term, and it's going to be secured by a 90% advance rates on AR inventory. Again, the rule here is it has to be at least 50% U.S. content, and the goods must be manufactured and shipped from the U.S. That's I've ran into this several times with folks who are manufacturing just a small component. They send it to Mexico, and then they need to go send it to Saudi Arabia. That just doesn't work. It has to be shipped, manufactured and shipped from a U.S. port. The COVID relief measures for XM, something to think about here is that the Working Capital Guarantee Program provided a 90% guarantee to U.S. financial institutions who underwrite these deals. That has now increased up to 95%. And the idea there is that it would help banks kind of free up a little bit of the credit and underwriting issues that they may have seen with folks through the pandemic. And they believe that will also help with loan creation. So the last I had heard, I did not hear an end date to that, but my guess is that we're going to probably be hearing that here in the near future of when those that 95% guarantee will expire, or if that'll be continued into the future. Last year, XM did a purchase financing order program. This is an extension of the Working Capital Guarantee Program. It's transaction-based. So you have to have been underwritten for the Working Capital Guarantee Program, but you can have this purchase order financing or POF arm on your loan, and you can advance 90% of the purchase order. Now, you may not have the inventory in store to make it, and you may have to procure that from a buyer. Therefore, the XM knows that there's going to be a lag from days to months between when the export order is generated and when you have to procure stuff. XM understands that the manufacturing of some of these complex things it takes time, and they're working through this on this purchase order financing. So you can utilize the purchase order to finance goods for the purchase of your inventory. I'm going to go back there and just say that you can have money dispersed off of this POF program before you have a security interest materialize. So if you buy the material but it takes them 30 days to make it, to bring it into your shop, you can advance on that. Again, it's going to be based on the expectation that there's going to be a security interest on that asset in the future. Real quick, we'll go through this here. The export financing programs. The main thing I want to point out is the green side over here. You can kind of see a company with $100,000 of inventory, $675,000 of working cap or foreign accounts receivable, and $150,000 of work in progress. Now, I'm giving you some just traditional advance rates I've seen in my years of banking, both for FMBO and other organizations, but an advance rate of 50% inventory and 50% on work in progress is pretty generous. And then obviously the foreign accounts receivable a bank doesn't want to touch. With the SBA or XM guarantee, what you're going to see is that inventory advance rate goes as high as 75%. The foreign accounts receivable up to 90%, and work in progress up to 5%. So obviously that's changed, or that makes a huge change in the amount of funds you're able to borrow on a monthly basis. So now, instead of only being able to purchase $325,000 worth to grow your export orders, now you have just shy of $1.1 million. So that provides that kind of shows the benefit that SBA and XM provide to your local bank. One of the new features that I've learned about in the last few years is the bid bond and the LC features. It's part of all the working capital loan programs, and it supports bid bonds, performance bonds, advanced payments guarantees. And what it does is it reduces the collateralization to as little as 25%. And so, obviously for folks who do business or do construction projects internationally, the bid bond, just ensures the buyer of your products and services that you're going to complete the order. If not, the buyer draws on the bond. And then we also seen, lately companies who need the working capital and basically say, hey, I need, I got a $5 million order for a company and I need, $2.5 million deposit. Well, then there's an advance payment bond that the buyer requires as part of the order. Well, if you're in a bank with a conservative credit policy, or normally 100% of those funds are going to be required to secure the advance payment bond that needs to be issued. But with XM, these can be reduced. So instead of $2 million, now you have a lot less collateral that's needed to support the issuance of that type of bond. The medium-term financing, this is kind of where we get into some very specific projects and long-term deals. But the financing here is for international buyers of U.S. capital goods related services. It's really not for consumer goods. The underwriting time is much more extensive. As a specialized trade finance organization, we do have some banks in the U.S. that do this, but there's also some third-party providers that need to underwrite the buyer, find legal counsel in the country, and secure a collateral option. It's, again, a win-win. The exporter, you get paid in a lump sum because someone else is going to hold the note, and you basically take a discount on that. And then someone else holds that note, collects interest, and is then supported by XM with a guarantee that they'll be paid. Generally up to 5 years in term and about $10 million. And then you also have the medium-term insurance, and I'm going to end on one more detail here, but this is again a way for you to utilize an XM insurance product. The exporter, you get to kind of keep really a promissory note on your balance sheet, but you're going to be protected by the insurance here. XM will insure 100% of the remaining finance portion of the contract and allow you to kind of amortize the purchase of that equipment that someone purchased from you for about 1 to 5 years. The only caveat here is they need to pay 15% down, and then you get to run the show from there. So no minimums or maximums here. And then the direct loans. This is, again, similar to the medium-term financing. The XM typically, again, underwritten by specialty programs. XM provides the guarantee of the loan, no limits on size. You can kind of finance the legal, financial, and lender fees on this. That's kind of nice for the buyer when you can say, hey, we need legal counsel in Costa Rica. What does that look like? How much is that going to be? It's not a cheap endeavor. And so again, these are really done through specialty finance programs with large assistance through XM Bank. Every time I've seen this, I've seen it used in kind of emerging markets. And the reason there is just the interest rate differential between the United States. You can provide a U.S. interest rate, fixed rate for a longer period of time at a cheaper interest rate than what you can see in some of these emerging markets. So again, one of the benefits, if you do provide a lot of project work, something to think about developing a relationship with a direct provider. So I'll open it up for any questions here, realizing that I've taken up almost all of your time today. But I'd be more than happy to answer questions as they pop up.
Yeah, so Matt, as of right now, we don't have any questions in the Q&A, but we obviously thank you for providing this information. want to thank the attendees for joining, and if you have any questions, please go ahead and submit them in Q&A, and we will answer them with the time we have left. All right. Well, Matt, and there's nothing here. We'll stay on for our next couple minutes, but again, thank you for Tom and Shreya and Heidi as well for setting this up, and we appreciate the opportunity. And feel free to ask questions or reach out if there's more information you'd like. So we did have one question: will a recording of this presentation be available for later viewing? Yes. I believe that we have recorded this, and we do make all of these available, so feel free to reach out and we can make this content available to you. One more thing is, again, the Education Committee is working on a series of webinars, so did want to highlight July 27th, we'll have one for compliance and documentation, featuring Karen Wyman, who's also a board member. August 11th at 3 p.m., we'll have a webinar that is going to be focused on logistics. And the 25th, we'll have more export assistance programs as well, and hope that everyone can attend those as well. We've got some great programs coming here soon, and more to come throughout the rest of the year. Perfect. Well, thank you, everybody. Appreciate your time, and hopefully everyone enjoys the rest of your afternoon.
Thank you.